So your thesis is, and let's look at these slides again, at least hypothetically, just for the time being. Your thesis now, continue your thought process about what started to change now. We've got institutions in commercial real estate dominating the industry, and then suddenly crowdfunding is born. Then what did you see over there that you weren't expecting to see when you got into Realty Mobile?
Well, when the institutions, I mean, when I was a partner at Rockwood Capital, a firm with, I think they're probably on their 11th fund at this point, long history of institutional investing, really in using mainly the allocator model. One thing that probably about 2002, I would say, some of the, there started to be a lot of noise within the institutional world about what's called the double promote. And what happens with the fund is, a closed-end fund, a fund manager like a Rockwood or 50 others that are out there, they will charge they'll charge a promote over a pref. So once a real estate developer, they'll provide limited partnership capital to a real estate developer. The real estate developer will, let's say they do a home run, and I have a chart there that shows the numbers, but let's say they have a home run, they have a big IRR. That capital will go into the fund, and then the fund manager will take a promote off of the cash that comes in from the various operators. That's called the double promote. And, it can shave 3, 4, sometimes even 500 basis points off the institution's return. And in some cases, look, if there's a great fund manager, the theory is, well, wait a minute, we're receiving 4 or 5% because you just got a 18, 19% return thanks to our investment selection. So but at the same time, the institutional investment world said, well, wait a minute, you're kind of skimming a lot off the top. There's a lot of allocators out there. You're not that special anymore. We want to go directly to the sponsors. Mm-hmm. So really, I would say the group that really led that charge was Yale. The Yale endowment with David Swensen.
Right.
Absolute genius. I think the world of him. So David Swensen had the idea that, well, I'm not going to invest in a fund. I'm going to invest in a sponsor who is perfectly capable. They're institutional quality. They're perfectly capable of managing my capital. I don't need a third party. So Yale poured hundreds of millions of dollars into Shorenstein, for example. They're well-known backer of Shorenstein. Also, they were a big investor in JBG in Washington. So there became this groups that really relied upon the managers to act as fiduciaries. Some pension funds couldn't avoid it. They needed a fiduciary. But some felt that they could just invest directly into, the JBG and a lot of sponsors. They raised their own fund. They didn't need, the allocators to provide the capital.
Right. And then the other issue, of course, for institutions is ones of scale. I mean, if you go to, well, you talk about allocators, but if you go to a private equity shop, and I worked for one, and we did all of our own deals, but I know that there were those who would look for sponsors. It's harder because you got to find sponsors of scale. If you've got hundreds of millions to invest, you don't have too much of a concentration, and you also don't want your sponsor to have too much of a concentration for you to be dependent. Right. But there are issues with that as well.